All right, you know that feeling, right? You're staring at a chart, you see maybe 2, 3 perfect-looking zones, and you freeze. You're completely paralyzed. Because picking the wrong one, that's going to cost you. But picking the right one, it feels like you've cracked some kind of code. Well, I'm here to tell you it's not magic. It's a strategy. And in this explainer, we're going to break down exactly how to solve that problem.
So first up, let's talk about the core conflicts that every single one of us faces. I like to call it the trader's dilemma.
Okay, so picture this. You're looking at a chart, and it's just a textbook uptrend. I mean, it's beautiful. You've marked out a few different order blocks, and honestly, they all look pretty good. But then comes the million-dollar question. Which one do you actually take the trade on? I mean, really, this single choice, this is it. This is what separates a fantastic win from a really frustrating loss.
And usually this whole situation leads to one of two, well, pretty painful outcomes. On the one hand, you could jump in on that very first zone you see. But what happens? Price just slices right through it. Boom, a quick loss that totally shakes your confidence. Or, on the other hand, you decide, you know what, I'm going to be patient. I'm going to wait for that extreme, that lowest zone. But price never even gets there. It just takes off without you. A totally missed opportunity. And let's be honest, both of those outcomes, they really, really hurt.
So you're probably thinking, there's got to be a better way. And you're right, there is. The solution, the real key, is learning how to tell the difference between two very distinct types of zones, what we call an inducement zone and a true zone.
And that's where this comes in. It's called the inducement strategy. Think of it as a specific method, a playbook, for telling the traps apart from the real high-probability zones. It's a framework that's designed to help you stop guessing and start actually identifying where those real institutionally backed opportunities are hiding.
Okay, so let's get our terms straight. First up, the inducement zone. The word inducement literally means to persuade someone to do something, and that's exactly what this zone is designed to do. It's a trap. It's meant to look like a fantastic opportunity to get you to jump in. Then we have the true zone. This is the real deal. This is the strong, valid area where the big institutional orders are actually sitting, and it's where the next major move is going to kick off from.
So the big question is, why do these traps even exist? Well, it all comes down to how the market moves. That top area, the inducement zone, is basically weak bait. Why? Because it leaves behind an imbalance, that sort of unfilled gap in price. It also creates a big pool of liquidity right underneath it. Think of all the stop losses sitting there. The market is basically engineered to be drawn to that liquidity, like a magnet. It wants to sweep down, grab all those stops, fill that imbalance, and then finally reach the true zone at the bottom.
Okay, so we know these two types of zones exist. But that's the easy part, right? The real key, the trick, is spotting the trap in real time as it's happening. And luckily for us, the market gives us one really, really clear signal to look for.
So what is it? What's that one telltale sign? How can you look at two potential zones and know, with confidence, which one is the trap and which one is the real deal?
And here's the answer. It's honestly simpler than you might think. It is all about the strength of the break. So look at this. On the left, you've got a weak break. See how the price just barely pokes above the previous high with the wick? That's a huge red flag. It signals a weak zone. But now look at the right. That's a strong break. We're talking a full candle body closing decisively above the high. Now that signals a powerful, valid zone. That's where the real shift in the market happened.
Look, if you take away just one single thing from all of this, let it be this. The zone that caused the strongest break is the zone you can trust. Burn that into your brain. It's the absolute foundation of this entire strategy.
All right, so that's the theory. It seems good, right? But now let's put it to the test. Let's pull up a real chart and see exactly how this works in practice.
Okay, here we go. This is a 1-hour URUSD chart. You can see 3 potential zones to place a buy order. This is that classic dilemma we started with. So, based on what you've just learned, which one are you picking right now? Zone 1, Zone 2, or Zone 3? Think about it.
All right, first things first, let's get rid of the obvious trap. Take a look at Zone 1. You can see that clear area of imbalance sitting right underneath it. And since we know price loves to fill those gaps, we can pretty confidently label Zone 1 as a classic inducement zone. So right off the bat, we're not even considering it.
So that leaves us with Zone 2 and Zone 3. Now be honest, your gut instinct is probably telling you to go for Zone 3, right? I mean, it's the lowest one, it's the extreme, it looks like the perfect spot. But what if I told you that's actually the wrong choice? This is where the strategy gets really interesting. Let's really zoom in and look at the chart. The move that started from Zone 3, look at the break it created.
It was weak. It just barely wicked over the previous high. But now, look at the move that came from Zone 2. That is what created the strong break, the one with a full body closing above the structure. And that is our clue. That tells us Zone 2 is the true zone. That's the one with the real power behind it.
And here's how it played out. Because we trusted the strength of that break, we waited patiently for price to come down into our true zone, Zone 2, and then we got our confirmation on a lower time frame. What happened? We were able to enter a calculated, high-probability trade. Our stop-loss was safe, and price took off right to our target. See? This wasn't a lucky guess. This was an entry based on actually understanding what the market was telling us.
Okay, let's boil this entire thing down into a simple 3-step playbook that you can literally start using today.
Here it is. Super simple. Step 1. Identify the inducement. Just find that first, most obvious zone that's practically screaming, "Trade me." That's probably your trap. Step 2. Find the true zone. This is the most important part. You have to analyze the strength of the break of structure. Whichever zone caused the strongest, most decisive break, that's your target. And finally, step 3. Wait for confirmation. And please do not just jump in blindly. Once price gets to your zone, drop down to a lower time frame and wait for the market to give you a clear signal that it's ready to turn around. Then you can enter.
So, we're going to end with this, the main takeaway. Trust the break, not just the location of the zone. The market is always leaving behind clues for people who know what to look for. And as we've just seen, the strength of a structural break is probably one of the most powerful clues you can ever find. It's the key to staying out of those nasty traps and, more importantly, aligning yourself with the real intended move.